today's video, we're going to talk about how to make it rain cash by investing in Treasury bills. Alright, maybe I'm exaggerating slightly, but we are going to talk about how to make a decent return with a relatively low risk instrument. But before I get into that, a little disclaimer: I am not your financial advisor. I'm just a random guy on the internet that likes to talk about investing and trading stuff. If you're thinking about buying US Treasuries, you need to do your own research, consult your own financial expert. My video is just here for entertainment value. I'm going to go over my strategy and my reasons behind it. So take it with a grain of salt and do your own digging before you invest in anything I talk about. So a brief overview of what US Treasuries are. It's basically bonds the government sells as part of its strategy to finance itself. So the government will issue these bonds and sell them on the market to anybody who wants to buy them. It could be individuals, it could be financial institutions, it could be foreign governments. The terms of these bonds fluctuate with the interest rate, as well as supply and demand. So the government will issue these bonds, sell them off, and the buyers of these bonds will earn a rate of return on their investment. So let's say you buy a 30-year bond with a 5% return. Let's say, to keep the numbers simple, you buy $10,000 worth of this bond with a 5% yield. How that's going to work is, for the next 30 years, you're going to get a 5% return. You'll get semi-annual interest payments equaling to about $500. That would be roughly 5% of $10,000. So for the next 30 years, you'll get those interest payments of $500 per year. At the end of the 30 years, you'll get your principal back. Now let's say you don't want to hold the bond to maturity. Let's say you hold it for a few years, then you decide you need the cash and you want to cash out your bonds. Well, you can sell it on the secondary market, but you may have to sell it at a discount, or you may be able to sell it at a premium depending on what the current interest rate is when you go to sell it. For example, let's say, so in using our 5% return, let's say we bought the bonds when they were paying 5%. Let's say a few years from now you want to sell it, but a few years from now, hypothetically, the interest rate might be at 7%. Well, because the interest rate is higher than what you bought your bonds for, and new issue Treasury bonds are going to be paying a higher yield, you'll have to sell yours at a discount to make them attractive to anybody who want to buy it. Why would I buy your bond that's paying 5% when I can buy a new issue bond that's paying 7%? So in that case, you'd have to sell your bond at a discount. Conversely, if the reverse becomes true, let's say you buy your bonds and they're paying 5%, a few years from now the interest rates go down and the new issue bonds are only paying 3%. Well, now your bond that's paying 5% is a little more valuable, so you can sell it at a premium. So that's how bonds and notes work. There's basically three different types of treasuries. You have bills, bonds, and treasury notes. The bonds refer to the long-term bonds, say the 20 to 30 years. The notes refer to the intermediary term, 2 to 10 years. And the bills are the short term, so anywhere from a month up to a year. Now, bills work a little bit differently. So the bills don't give you annual interest payments because they're short term. Instead, you buy the bills at a discount price, and when they mature, say whatever the term is, whether it's a month, 3 months, 6 months, or a year, when they mature, you'll get the full value. So for my strategy, I'm interested in the Treasury bills, and I'm specifically interested in new issue 3-month bills. I'm gonna buy the bills today or now at a discount. 3 months from now, I'm gonna get the full price back when they mature. So let's talk a little bit about risk versus reward. In life, everything is a trade-off, and nothing comes without risk. That said, treasuries are considered to be fairly low risk because they're backed by the government. And despite the never-ending clown show put on by our politicians and the media, historically speaking, the US government is pretty stable and pays its bills. So buying treasuries is considered to be low risk. Now, nothing is guaranteed. I mean, it is entirely possible that the government could collapse and or default on its debt. That said, the sun could explode tomorrow. I'm not going to spend a lot of time worrying about that scenario, but it's entirely possible that the government could collapse and your treasuries could become worthless. However, in that scenario, what would be safe? I mean, in that scenario, the money deposited in your savings account in your bank probably isn't going to be worth anything. Even then, cash you have hiding under your mattress in that scenario would become suspect. In the apocalyptic doomsday scenario, but the only thing that's going to be worth anything is guns, food, and ammo, and the relationships you have with people that have practical skills. But short of a doomsday scenario, U.S. Treasuries are a pretty safe bet. That's why individuals and entities around the world like to buy U.S. debt. However, there's usually an inverse relationship between risk and reward. The safer a bet is, the less reward there is. The polar opposite of buying a treasury bill would be maybe buying a lottery ticket. Pretty much any money you throw at lottery tickets, you can assume you're throwing away, but there is that odd chance that you might, win big and become a millionaire overnight. Treasuries, it's the polar opposite. You're gonna buy these treasury bills. They're super safe, but you're gonna get a very, very small return. So for that reason, in a lot of markets, treasury bills aren't attractive to me at all. In a market where interest rates are really low, and let's say we're in a bull market, the stock market's doing really, really well. In that scenario, treasury bills become less and less attractive because the reward isn't there. Sure, there's no risk, but you could probably get a better rate of return in other investments. If interest rates are low and the market's booming, I might be more apt to put my money into an index fund, say the SPY, which is a S&P 500 index fund, or the NASDAQ, the triple Q, maybe a high interest or a high yield, the dividend ETF. Something like that might be more attractive in really good times when the interest rates are low. However, in certain scenarios, say if interest rates are going up because the Fed's trying to combat inflation and the market's kind of on shaky ground, where you might put your money into a stock market index fund and you might end up losing money in the short term because you might be going into a recession. In those types of markets, treasury bills become more attractive because they are a safer bet. So in this video, I'm not going to go into detail in how you buy treasury bills or bonds. There's other videos you can find that will explain that in detail. Basically, you can buy them directly from the treasury, or you can buy them through any number of brokerages. Fidelity, E-Trades, pick your favorite broker. They probably sell treasury bills. You can look up other videos to figure out how exactly to do that. But I am going to go over my strategy. So again, my strategy, I'm buying the 3-month treasuries, and I'm buying the new issue treasuries. So the ones that the treasury is auctioning off at the time that I'm buying them. All right, like I said, the treasury bills don't give you annual interest payments. Instead, you buy them at a discount price, and then when they mature, once their term is up, you get the full value back. So for example, right now the effective return is right around 5% APR. So if you buy a 1-year treasury, you'll expect to pay $95 for it, and when the 1 year is up, you'll get $100 back. That's where you get your 5%. The 6-month bills, you'll expect to pay somewhere around this price, and you'll get $100 back at the end of the 6 months. The 3 months, you'll pay somewhere around there, and you'll get $100 back in 3 months when the bill matures. Now, if you're saying, well, that doesn't look like a 5% return, keep in mind that's because this is a 3-month bill. If you're having trouble understanding APR, that's annual percent return. An apt comparison I find is miles per hour or kilometers per hour, depending on what part of the world you're in. So let's say you're traveling 60 miles an hour and you travel for 1 hour. You went 60 miles if you travel 60 miles an hour, but you're only traveling for 30 minutes, well then you went 30 miles, and 15 minutes at 60 miles an hour will get you 15 miles, and you can plug in whatever rate you want here. So if you're going 100 miles an hour, 1 hour is going to move you 100 miles, half an hour is going to move you 50 miles, 15 minutes is going to move you 25. It's the same thing with this APR. So this is what the discount price looks like on a 3-month bill. I think I paid actually a little bit less than that for the last bills that I bought. I think I paid 89 and 66 cents. Alright, so here's my basic strategy. So I'm buying the 3-month Treasury bills, and I'm buying some every month. So let's say, just to keep the numbers simple, we'll say we've got $10,000 that we want to start buying Treasury bills with. So in October, I'm gonna split this 10,000 into 3 parts. In October, I'm gonna take a third of that money and use it to buy Treasury bills. And this was the discount price that I paid. So this is roughly the amount that I got. Now in reality, you have to buy them in $100 increments, so you'd either have to buy 33 of them or 34 of them. And actually, a lot of brokerages require you to buy them in $1,000 increments, so you'd have to buy either 30 or 40. But this is just for demonstration purposes. So this is the price you pay, the discount price. This is what you'll get back when it matures in 3 months. So this is the effective return, your profit on roughly $3,300 worth of Treasury bills. In 3 months you'll get the maturity, you'll make $45, and these will mature. I bought these in October of this year. They'll mature January of next year, so 3 months later. Now in November, did the same thing, bought another chunk of Treasury bills, still about the same price, and I'll make roughly that much when they mature, assuming you're using $10,000 for this. Now those will mature in February of next year. So December I haven't bought yet. I'm assuming this is roughly the price I'll get. It might be less, it might be a little bit more. And then the ones that I buy in December will mature in March. And what I'm going to do is, when these mature in January, I'm just going to take that money, and assuming I don't need it for anything else, I'm just going to buy more Treasury bills with it in January, and I'll just keep the snowball going for as long as I want to do this. For as long as interest rates are good and I don't have a better use for the money, and that's what I'll do with my excess capital. Now you can plug in any amount you want. Let's say you only have $5,000 to do this with. Same concept. You'll still be making roughly 5% APR, and then each month you'll get an extra $22. Or let's say you've got $100,000 sitting around in the bank, and you do this. Well, in that case, if you use the same strategy, you'll potentially be making another $450 a month starting next year. And if you keep rolling it over, every month next year, you'll have an extra $450 to deal with. And for me, that'd be a pretty good chunk of change. That's going to cover, most of my utility bills next year. So you can scale this strategy to whatever you can afford. Now, for me, I'm using basically my emergency money that I have set aside just in case I lose my job or something like that. And you might be saying, well, why don't you just buy the 1-year Treasury bill, and then you don't have to do this every month. You can just buy, put all your money once into the 1-year Treasury, and a year from now you'll make your 5%. Well, the reason I'm doing it this way, the reason I'm buying the 3-month Treasuries, is because I figure worst case scenario, because this is the money I have set aside for a rainy day, worst case scenario, it's only going to take me 3 months to roll out of this. So let's say January 1st comes around and my company decides to downsize, and I lose my job, I get laid off. Well, each month a chunk of these Treasury bills that I've accumulated are going to mature, and within 3 months, I'll have my $10,000 back out of this. And if I don't lose my job, well, then I'll just keep rolling my money back into these treasury bills, and then for the whole year, I'll have an extra. In this case, if I'm using $10,000, I'll have roughly an extra $45 to play around with each month. And then for me, that'll cover my my internet bill, or it'll cover something. Fill up my gas tank a couple of times. And even if you only have, let's say you only have $3,000 to play around with. Let's plug that in. Well, that'll get you an extra $13 or $14 a month next year. But at least you'd be learning how this works. You're learning how to buy treasury bills in your brokerage account, and in a scenario where you have more money to play around with, you'll have potentially be able to scale this up at some point. So my plan is to keep doing this until market conditions change. If interest rates start to come down, obviously these treasury bills will pay less and less. And if the market starts to turn around, and I think we're going to be in a bull market for a long time, I might look for an investment that will give me a higher rate of return. But in the meantime, this seems like a pretty good strategy to me. So that's my treasury bill strategy in a nutshell. And you can plug in any amount you want to try to figure this out. So you have $50,000, and you're buying, each month you'll buy roughly $16,000 worth of 3 months treasury bills. Well, it's still going to give you another, once these bills start to mature, it's going to give you another couple $100 each month to play around with. And that's not nothing. I work hard to earn my money, selling my time to my employer. I like to try to find ways to make my money work hard for me, so that eventually I could spend less time working for somebody else and having to sell my time to make money. So that's my treasury bill strategy for 2024. Like I said, it's subject to change if market conditions change, or if my situation changes. But what's your strategy? This is how I plan on trying to outpace inflation, or at least keep up with it. If you've got a strategy different from mine, then by all means let me know about it in the comments below. You've been watching the Fletch Report. If you're hearing this, it means you've made it to the end of the video. But before you click onto the next thing and continue down whatever rabbit hole you're on YouTube or Rumble, I've got a small favor to ask. If you found value in my content and you want to help the channel out, the best thing you can do is share it with somebody else that you think will find value in it. Don't forget to hit the like button. Subscribe if you want to see more. Links to the channel on YouTube and Rumble will be provided below. Additionally, I'm making a Facebook page for the channel, as well as a X/formerly Twitter. Feel free to follow me on those platforms as well. If you're feeling exceptionally generous, provided in the description below will be a link to Buy Me a Coffee, which is the online equivalent of a tip jar. Thanks for watching, and thanks for supporting the channel.